Hi, good morning. It's morning on my end, and it is also yet to trading is yet to open in the US, which makes this video, I would say, somewhat timely. So, yesterday, United Health, which is a major health insurance firm in the US, announced some key news. The CEO abruptly resigned, and acting CEO is the current chairman, who is the former CEO, was CEO for about what 10 plus years. He's coming back. So the CEO, Andrew Whitty, resigned unexpectedly. Current chairman has become CEO. And the part that really shook financial markets was the company withdrew its 2025 outlook. And that isn't surprising because you're seeing companies in the US, because of all the uncertainty, withdraw guidance, withdraw forecast, warn that look, we don't know how the next few quarters or next few months or the rest of the year will shape out. But the surprising part is a few weeks ago, they had released their Q1 2025 numbers, which went bad actually. Um, and then just fast forward a few weeks after, you now say, hey, there's a lot of uncertainty because the Q1 call was just barely 2 3 weeks ago, about 3 weeks on the 17th of April. So that's about almost 3 weeks ago. And so markets were spooked by it. The share price fell sharply. If you follow me on Twitter, I'm sure you probably, and if you can just go online, you just Google United Health share price or UNH share price, and you can see how it fell. It fell quite sharply. I have a couple of numbers just underneath the headline. So you can see market cap. Market cap is the total number of shares the company has multiplied by its current share price and the likes. And so the company is trading at a market cap of about 282 billion. Revenue for last year was 400.3 billion. So, in my view, and the disclaimer is at the bottom in red, it's not financial advice, go do your own research. It doesn't make sense for a company that made 400 billion in revenue to be trading at a market cap of 282 point odd billion. I mean, even if we want to be conservative and say, hey, maybe revenue is going to drop to 300 billion this year, it still doesn't make sense for a company that makes 300 billion every year, or let's say it's going to do that constantly every year, to be trading at 282 billion. You should be doing what? Maybe 400, 500, 600 billion. So clearly the stock is undervalued, but you're still going to have a bumpy ride ahead. Now, they had a brief call yesterday where they just talked barely 20 minutes. And so the analysts were allowed to ask questions, and they said, look, we are seeing higher utilization of health insurance by seniors, the elderly, and just generally across the different lines. Now that's a bit worrisome because this is a company that has very tiny margins. So for every $100 in revenue, profit is around $5 and some odd fraction. So it's a very tiny margin business. And so what people inferred is if you are finding pressure in terms of costs, and of course you can't raise revenues sharply, then it means that your profit margins are going to go down. Now, in my view, I think a target entry price would probably be the 280 to 300 range. Yes, post market close yesterday, the stock price has recovered, and I would expect to see further recovery today when the stock market in the US opens. But it's a long road ahead for this company. I wish they had given more color as to how badly they think 2025 would shape out. Then you can have all the shock plugged into the price and likes. But with this, we probably would see more color in their Q2 and Q3 numbers, and then one can estimate for the next couple of quarters. So in my view, I think this is probably where would be a great target entry price. There are also a few unknowns. Are they going to cut their dividend? Are they going to reduce share buybacks? I mean, Q1 this year, they made operating cash flow of about 5 odd billion. And but for the borrowing, you probably would have seen that the dividend, share buybacks would have taken essentially most of the money. So I think that one of them is going to be cut, most likely share buybacks, which, yes, you might argue, look, buybacks are great. And by buybacks, a company buying its shares periodically. I mean, the share price is cheap, but when you have a tight economic environment, the question is, do you want to buy shares? So between buybacks and shares, I mean, in dividends rather, I think that the dividend may survive because it's not very large compared to the buybacks, but the buybacks will get cut. So I hope you found this useful. Please like, share, subscribe. Disclaimer is clearly written in red. This is not financial advice. Do your own research. But for me, as an analyst, it's I mean, the dip in this stock price has been so sharp that not to it's hard not to do a video on it. I mean, I'm looking at it. It's the worst performing stock in the Dow, which is an index. And the last 1 month is following almost 50%. So that's really, really huge in terms of decline. So let me know what you think. Are you on the opposite side? Are you on my side? This is a firm also that doesn't have a lot of love because it's a health insurance firm. If you just do a Google search on or go on Twitter and search, you see a lot of people complaining about service, poor payments, and they just being unwilling. So a lot of people were in the US were happy with this news, but so I also hope that management can work on just, and it's hard because it's insurance. It's you really would step on toes, but I hope that management can work on this and end up with a recovery in performance. So have yourselves a great day ahead.